For those that want to be more passive, so they don't want to be in the trenches negotiating deals, managing properties, or you know, raising $20 million for the next deal. The passive investors, what should they be looking for before getting into in multifamily investing?
I would say you're always looking for a track record, right? You know, I mean, everybody's a slick salesperson. They can throw up great metrics, and you know, you can sell the sizzle a little bit, right? But
so the pitch deck is not always 100%.
it's not always, and I've seen some really slick ones, and it, you know, once you dig just a little bit beneath the surface, you realize it's all BS, right? Like at the end of the day, you have to have a great team, and it doesn't mean this is actually a piece of advice for people that are starting off. Doesn't mean that you've had to have sold or refinanced 20 deals for anybody to take you seriously. You know, everybody started at zero. I had to talk people into my first deal, right? You know, why the hell would I invest with you? You've never even done this shit before, you know. But I'm going to tell you a key to success when you're kind of dealing in at least in the syndication world that I'm in, right, is you can leverage other people's experience too, right? So the reason that people gave me $800,000 on my first deal was because I was partnered with a guy that had been doing it for the last 10 years. Right, so I leveraged his track record and his experience, and he was there to kind of help and coach me along the way, right? You know, so you have to kind of take that into consideration when you're kind of coming at it from a passive investor standpoint, you know. But also find out what your box is. A lot of people are just they find out about it and they get all excited, and then they just throw their money into the first person that throws them a deal, right? You know, don't do that, right? Figure out what market you want to be in. You know, what type of product do you want to be in? How long do you want to have your money tied up in, right? Because there's projects that are, you know, short as maybe a year to up to 10 years. Actually, shit, I've seen stuff that's longer than that, right? You know, so you need to be very, very aware of like, okay, I want to be in Houston. I want to buy, you know, a Class A property, and I only want to have my money tied up for 5 years, right? And I want to have these types of returns. Like you can, yeah, it might take you a little bit longer to find that deal, but at least you know what you're getting yourself into, right? Instead of just throwing money at whoever throws you a deal. So I think that that's important from a passive investor standpoint, right? You know, look at the track record, ask the questions. This is your hard-earned money. You know, I mean, we have a lot of Quest investors on our deals, right? You know, this is the retirement funds. You know, you're entitled to ask a couple questions, right, about somebody's track record or about the deal or about the market, but also, you know, getting yourself educated and understanding what you're investing into and what you want to invest into is important too, right?
Okay, so obviously, you know, I don't take any passive investors. I don't, you know, pitch any investment on deals that I have. So what I do want to say though is, if you're thinking about passive investment, just please ask yourself, could I do it better? I know I have a full-time job and I'm an engineer and I don't have any time, but is there any other way that I can own real estate, right? Have the depreciation and go through a forced depreciation and everything like that. Just ask yourself, how hard can it be? And if the answer is still you're not going to have any time, you're not going to be able to do it, then obviously passively invest. You got to at least do that, right? If you want to start generating wealth, is, you know, invest it with a really good team like Disrupt Equity. You know, again, one of the biggest and best companies to invest in. I always said that if I was going to invest passively, it would probably be with them. So, yeah, definitely but at least ask yourself, like, okay, do I really just want to leave my money tied up for years on end, or could I get to my goal a little faster if I just actively invest?
And so, do you work with private money lenders?
Yeah, so I work with hard money lenders that let you borrow up to 100% of the cost of purchase and rehab. So that's zero down. All you bring to the closing is your closing costs, right?
So there's by passive investors, there's really two ways you can be an investor. It's either equity or debt. You know, Ben's probably primarily on the equity side, where you're raising money from folks that are essentially business partners, passive business partners. And the 19 million that I mentioned earlier, most of that has been raised, I've raised for the flips that we've done and our rentals, has been primarily debt partners, folks that we had to buy a deal. It's going to be $150,000 plus another 50 to rehab it, and they gave us 200,000, and it was be worth, you know, 350. So just keep that in mind.
And I think maybe we make a distinction between, I mean, I don't know who's all tuning in, right? But obviously equity You know, they'll get sometimes they'll have some kind of cash on cash, you know, expectation. So if they put $100,000 in, maybe they'll get 10,000, but they share in the upside, right? Which is the refinance and the sale proceeds versus if it's debt, which we've kicked around too, and we could probably structure our deals that way too. And I actually know syndicators that do it that way, right? Where it's essentially, they're getting a second lien on the damn thing and they're getting their 8% coupon every year, right? But they don't get any participation in the upside. So there's a distinction between the two, and I wanted to make that because, you know, I mean, how you structure your deals, you know, could make or break the deal first and foremost. But it's also, you need to know that going into, if you're gonna raise money or structure, even in, like you said, even flips, right? You know, knowing how all that works is important. So I
Yeah.
just wanted to make that distinction.
Yeah, it's all risk-adjusted returns.
Yes.
And you become more attuned to it as you look at multiple opportunities and see what folks are offering out there, and get more educated in the different assets.